Hello traders, welcome back to the sixth video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools, and community support to excel in the financial markets. Today, we are diving into one of the most critical aspects of trading, the psychology of Forex trading. Understanding the psychological factors that influence trading decisions can help you achieve long-term success. So let's get started. Video Part 1. In this part, we will discuss what are psychological factors and what are their impacts on the Forex trading. Introduction to trading psychology. First, we need to understand what is trading psychology. So the definition goes like the trading psychology refers to the mental and emotional state that influence a trader's decision-making process. Trading psychology, in simple terms, it focuses on you and your way of thinking, your attitude, your personality, and by combining all of these factors, you will know that how you will gonna react in certain market situations when it is about to take important decisions. For example, emotions such as fear, greed, and stress can greatly impact how a trader behaves in the market. So you need to understand how fear or greed is affecting your way of thinking and how you are taking trades based on it. Why trading psychology matters is a deep understanding of trading psychology is crucial because it affects your ability to stick to your trading rules that you have created. Okay, and we also know that there are many good things that we should do, but are we doing that? No, because we are not that much disciplined. So in trading, what you need to do is you need to make some rules and stick to them. Whatever happens, you are not abandoning those rules. So this is what trading psychology is. For example, even the best trading strategy, like you have back tested it and it says that it have 95% of winning ratio, but if you are not able to control your own emotions, then that 95% success rate strategy will also gonna fail. So that is why you need to control your emotions. Traders who manage their emotions effectively are most likely to stick to their trading plans and their rules, and they can create a good consistency out of that. Many big traders say that psychology is 80% of your trading area and the skill to analyze the market plays only 20% role in whether you are succeeding or you are failing. So if you have a weak research skills or you are still developing it, and on the other hand you have a very strong mindset, your psychological ability to make decisions are very strong, then it is very likely that you will gonna achieve a good consistent result in the upcoming future because you are not influenced by others. You are sticking to your ability to think and to make rational decisions. Let's see some key elements of trading psychology that traders face and they have a high impact on the trading decisions. Emotional regulation refers to the ability to manage and respond to your emotions in a healthy and productive way. In trading, this means controlling feelings like fear, greed, stress, and overconfidence to make rational decisions. Managing your emotions is essential to avoid impulsive decisions. For example, instead of panicking during a market drop or a market fall, a trader with good emotional regulation will calmly assess the situation and stick to their plan. In practical life scenario, we have seen many times that when a market falls, big players with strong mental attitude starts to accumulate some stock or currency pair in their portfolio. But on the other hand, what will a retail trader or a trader with weak emotional mindset will do? He will start to panic, and instead of buying more at cheapest price, they starts to sell it from their portfolios. Okay, so this is how you need to develop your mindset to handle those kind of emotions in hard times like market crash. The second example, you can see that we as a retail buyers influenced by some research analyst or some news, and we end up buying at very high prices where the technical analysis does not suggest any buying opportunity. It is too much high. The train has already left the station. So what will gonna happen? We are buying in the emotion of FOMO, fear of missing out, and we end up buying at the very late in the uptrend. And at that time, the smart players or the big players are unloading their portfolios. They are booking profits. So we should not influenced by these kind of emotions, and instead of that we need to maintain a strong attitude that can result in a very good decision making mindset. Next is mental discipline. Discipline helps you follow your trading plan and stick to your strategies that you have created after a thorough backtesting and observations. For example, a disciplined trader avoids overtrading and focus only quality trades that has been generated from their own strategy and not jumping on any other's recommendation or taking any trade in FOMO. That is why you need to have a very good mental discipline while you are executing your trades in Forex market. Third point is confidence versus overconfidence. Confidence is very good while planning and executing your trades, but after confident state of mind, generally people shifts toward overconfidence mindset because they think that they are unbeatable. They whatever are buying will gonna result in profit only, but that is not the case in the trading business. Confidence in your trading plan is important, but overconfidence can lead to excessive risk taking. So typically what happens when a trader is winning a series of trade, then what he will do is he will start to disobey their position sizing rules and they starts to take huge quantities in an order to make more money. And in this phase, only one single trade can wipe out their capital account. So that is why you need to have confidence, but you need to handle the overconfident state of mind with rationality. For example, a confident trader trusts their analysis, while an overconfident trader may ignore the risk management rules. Emotions can have a significant impact on trading decisions. Let's take a closer look at how specific emotions affect your trades. First point is fear and anxiety. Typically, fear of losing money can paralyze traders, leading them to hesitate or avoid taking their trades generated by the backtested strategy. So when you are trading with borrowed money or trading with a money that is required for some other responsibility, let's say you are using money out of your medical expenses fund, or you are using your children's education fund. Alright, so these borrowed money or other responsibility money will lead to some fear, and that fear can paralyze you in initiating good trade setups. That is why you need to have a proper balance. For example, a trader might miss a profitable opportunity because they are afraid of potential losses. So what will be the solution here? The solution is very simple, that you need to develop a risk management plan and stick to it. Whatever happens, you have to stick to your plan. That will gonna build confidence in your trade, and you will not gonna miss profitable opportunities, because in forex market, whenever you are taking trades based on your strategy, their result are probabilistic in nature. Either you are going to win or you are going to lose, but at the end of a month or at the end of 6 months or 1 week, you know that you will gonna win 65%, 70% or even 80% of the trade out of the 100%. That is what your strategy is showing you. So you have to trust that particular process instead of fearing on losing one single trade. If you just place your risk management plan and you always take equal quantities in your each and every trade, then the fear and anxiety factor will gonna diminish and you will gonna get a good confident mindset. Second factor is greed. Greed will gonna lead to mass destruction. That is why pre-planning is very important. Greed can lead traders to take excessive risk. As I said, when a trader is in overconfident state, they tends to take excessive risk, or they try to make double their capital in single trade or in just one day. So that is not gonna help you in making consistent result over a period of time. What you have to do is you have to manage it with the help of risk management, like position sizing, sticking to your target and stop loss levels, and buying only when the strategy is generating viable signals for buy and sell. For example, a trader might over leverage their position. What they are doing is they are going beyond their capacity of taking the leverage. In the previous risk management videos also we have discussed that leverage is two-edged sword. If it can make huge money, it can also wipe out your trading capital entirely. So that is why you need to use the leverage part very carefully. And greed, whenever you are in a greedy state of mind, you will gonna disobey your own rules of using leverage or position sizing, and you might end up taking a high leverage which is not suitable for your account. So that is why you need to manage it. And how you are going to manage that particular greed is simple, that you have to set realistic profit targets. Do not hope for an extended up move in one single day, or do not hope that when a losing position is running, don't hope for it to recover. Just exit it on your stop loss levels. You will always gonna have better opportunities in the market. The market is there for very long time and it will gonna be there for upcoming future also. So there is no shortfall of opportunities. There is only a shortfall of our trading capital. Again, the next factor is overconfidence. In overconfidence, traders overestimate their abilities. They think that they are the best market analyst or the best trader of all time, and they starts to take higher and higher risk, as we have discussed. So that will gonna not sustain for a long period of time. A trader who has a series of successful trades might start to ignore their strategy and make impulsive decision. So what will be the solution? Solution is regularly review and adjust your trading plan to stay under your limits. You have to grow step by step. Do not take bigger leaps in your journey. If you are following your plan, moving ahead step by step, a little by little, then it will gonna result in a very great success. Next is loss aversion. What do we mean by loss aversion? Loss aversion means that you are holding a losing position for a long period of time in a hope that the market will return in your favor and that losing position will gonna change into a profitable position. So these kind of things will not gonna keep your trading capital alive for longer period of time. You have to follow your rules. A trader might refuse to close a losing trade, leading to larger losses. That will gonna result in huge loss, right? Then the solution is very simple. You need to set the stop loss orders to limit potential losses and accept that losses are part of trading. So I have already said to you, it will all gonna depend on the strategy that you are using. If your strategy say that you have 70% winning ratio, then whatever you do, you still are left with 30 losing trades out of 100. So you need to accept those 30 trades as a losing, and that will gonna be just a simple and normal part of the trading. Video part 2. Let's decode some technique that will help you develop a positive trading mindset. A strong mindset can help you navigate the ups and downs of the forex market with resilience and confidence. First, let's discuss why having a positive trading mindset is so important. First point is it improves decision making. A positive mindset helps you make rational decisions rather than emotional ones. For example, when faced with a potential loss, a trader with a positive mindset remains calm and stick to their strategy. Even after some series of losses, he rationally thinks about its strategy, makes some modifications to it according to market condition, and then he plans its next move. Second is it enhances discipline. Trading discipline refers to the ability to consistently follow your trading plan and rules, regardless of market conditions or emotional state. It involves sticking to predefined strategies, managing risk, and avoid impulsive decisions. When you are not disciplined towards executing or planning your trades, you are intend to make many silly mistakes which can cost you huge money. So maintaining a positive attitude helps you stay disciplined and follow your trading plan. For example, instead of chasing losing trades, or a disciplined trader focuses on executing their plan consistently, because there is one saying in the market: plan your trades and trade your plan. So that is why you need to stay consistently disciplined in each and every trade. Third one is it boosts confidence. Confidence in trading refers to having faith in your trading strategy, skills, and decision making abilities. It is the trust you have in your analysis and the plans you have set for yourself in the forex market. For example, if you have said that you need to just make a profit of $80 in a day, then you are going to sign off your trading terminal. So this is a goal, and once you have achieved it with consistency and when you are following your plan, it will increase the confidence and helps you take bold decisions. Consistency in your trading decision can lead to better performance, and it will also reduce stress that you are not jumping from one trade to another. You are just focusing on what the market is giving to you. For example, believing in your analysis and strategy helps you stay focused. It's like many traders get influenced with the opinion of other people. They abandon their own analysis and they end up buying something else or taking any other opportunity and leaving their own. So you have to avoid second guessing your trades or your analysis and just execute with a proper position sizing rules. In the first part of the video, we have discussed about the factors that can create problems in trading, but now let's break down the key elements that contribute to a positive trading mindset and what factors you need to focus on to enhance your trading decision. So let's get started. First is patience. This is the most important factor fall into the psychology of forex market. Patience in trading refers to the ability to wait for the right opportunity and not rush into trades. You are waiting long enough for the market to give you trade. Trust me, it will gonna make a huge difference when the market is giving you trades versus when you are forcing a trade into the market. Like there is no opportunity for a breakout. The market is moving totally range bound for few days and then you are searching for breakout. Then it will not gonna help you in making more money. It will gonna cost you some stop losses if you are forcing a particular trade. In trending market, if you are finding some good breakout opportunities, then only it will be a good execution from your end. But forcing is not good. Patience allow you to wait for right trading opportunity and avoid rushing into trades. So do remember this part, that do not force any trade into the market. Do not jump on the first setup you see, or if it does not fulfill any of your rules, then just avoid it. There will be plenty more opportunities in the market. And in patience, there is one more thing that you need to focus on, is always wait for your planned target. So if you are using technical analysis, fundamental analysis, it does not matter. Targets and stop losses are some kind of psychological factors that can influence. Some trader might book profits too early, they are not sticking to their target levels, or some players even might book in loss before their actual stop loss is getting hit. So these practices are creating a bad habit in your attitude, and that will gonna create problems in your future trading. So that is why you need to always stick to your target or follow the technical levels. What if the market conditions are shifting, then trail your stop loss instead of booking too early. Next one is discipline. We have discussed many things on discipline. Each and every aspect comes to discipline only. If you combine all of the factors of trading psychology, it will conclude in just one word. It is discipline. Discipline is the key to sticking to your trading plans and avoid impulsive decisions. Many times we see that there is a forex reserve data is publishing, and on that forex reserve data the market can spike too much, okay, and you do not have a technical plan for it to trade. You have a fundamental news but you do not have any technical plan, so that will be a impulsive decision if you do not have a technical plan. But if you have fundamental and in combination to that you know that this will be my entry point, this will be my exit point, and this is the stop loss, then it will be a good disciplined approach to execute trades in the market. Because if you are not disciplined enough, then the emotions will gonna overpower you, and that will gonna followed by some big mistakes which can cost you huge money. Third is adaptability. Adaptability means that you are adapting according to changing market conditions. You are flexible enough. Whatever trading plan that you have created is flexible enough that you are able to modify it with a rational mindset. sometimes what happen, we have identified some breakout setups, and then when we go to that particular chart or that particular currency pair, we see that there is a very big spike in just microseconds. So if your order is not executed there, then you have to skip that particular trade. You should not buy in the top of the spike, because these spikes have disturbed your risk to reward ratio. Another example is, if there is some geopolitical events going on, there is news on wars coming in, and in that situation, if you have planned something a day before and big news come in and the volatility is too high, the market is moving by 200 pips in just few seconds only, then you should avoid. You need to be that much flexible that when you should trade or when you should avoid trading. Fourth factor is self-awareness. By self-awareness, you can enhance your forex trading and decision making process. Self-awareness is nothing but knowing yourself, what you can handle. If the market is giving you one particular trade and that particular trade have a bigger stop loss which you cannot handle, even in the minimum quantity also you are not able to control that particular position size, then you need to skip that particular opportunity and search for another one that will gonna help you manage those particular trades more effectively. A self-aware trader recognizes when they are feeling stressed or overconfident and take steps to address those feelings. In terms of stress, what many people do is they try to do some over trading. If they are winning consistently and they go into an overconfident state of mind, what they will do is they will pump up their quantity, and even one single trade, if it gone against their analysis, it can wipe out whole previous trades profits. So that is why do not trade when you are stressed, or do not, or control your position size when you are overconfident. Do not increase the quantity very significantly when the market is moving in your favor. Move ahead step by step. Fifth point is resilience. Resilience helps you bounce back from losses and stay focused on your long-term goals. Short-term losses will not gonna affect that much if you are disciplined and have a plan to cover that particular losses. Do not do any kind of revenge trading. A resilient trader views losses as learning opportunities rather than failures. Every loss trade is an opportunity to learn new thing. What you have to do is you have to give some time to that failed trade and find out where and what you did wrong, and note down that particular observation in your journal so that you will avoid that particular mistake in the future opportunities. So these are some solutions that will help you increase the positivity in the trading mindset. There are some techniques to manage emotions effectively. They are very simple and related to daily life activity. First one is mindfulness. Mindfulness is the practice of being fully present and engaged in the current moment, aware of your thoughts and feelings without judgment. It involves focusing on the here and now rather than dwelling on the past or worrying about your futures. The past is gone and the future is ahead. What you have to do is analyze the present market condition, okay, and make a plan to surf the upcoming market moves. There are some importance of mindfulness in trading. First one is it enhances focus. This will gonna keep your focus on your trading strategy and help you do better market analysis before executing your trades. For example, a mindful trader can concentrate on current market condition and make informed decision without being distracted by external factors. You are not getting influenced with any other thing. You are just focusing on your own strategy and market analysis. Next is reduces stress. Mindfulness practices can lower your stress level, which can improve decision making and overall well-being. For example, by staying calm and composed, traders can avoid panic and impulsive decisions during volatile market condition. Many times a trader make uninformed decision by seeing spikes. As I said before, spikes attract you to take a trade, and these spikes wants you to make a mistake so that a big player can make money. But these spikes not every time result into a profitable setup. Sometimes they can trap you and cost you huge money. So that is why you need to practice mindfulness, which is just giving 100% of your focus into what you are doing. Second is meditation is a practice that involves focusing the mind on a particular object, thought, or activity to achieve a mental, clear, and emotionally calm state. There are some benefits of meditation, and it's not for trading only. It will gonna help you in your regular life routine also. So it increases mental clarity. Regular meditation can enhance cognitive functions such as attention, memory, and problem solving skills. For example, a trader who meditates regularly may find it easier to analyze charts and identify trading opportunities much more quicker than the other person who is always stressed and not doing any kind of meditation. He does not have a presence of mind there. Next is it promotes calmness. Meditation helps reduce anxiety and promote a sense of inner peace. Example, during stressful trading session, which can be volatile, when multiple types of news are coming into the market, that session can be a very stressful because the fluctuation or the volatility is very high, and a trader who meditate can remain calm and composed, making more rational decision, or he can control himself by for taking any unnecessary trade in that volatile market. And it also encourages discipline. Meditation fosters a disciplined mindset, which is crucial for sticking to your trading plan and the rules. There are some practical techniques for mindfulness and meditation. First one is deep breathing exercise. Take slow, deep breaths, focusing on the sensation of air entering and leaving your body. This can help you remain calm the mind and reduce stress. Before starting your trading session, you can give 5 minutes on deep breathing to center yourself and gather your focus onto the trading opportunities. Body scan meditation is simply just close your eyes and focus on your body from head to toe, paying attention to sensations or any areas of tension that will help you increase body awareness and relaxation. Then mindful observation. Take a few moments to observe your surrounding without judgment. Notice the colors and shapes and sounds around you that will gonna take you into the present moment. Guided meditation. Follow a guided meditation. You can take help of any expert. It includes instructions, or you can use music to help you relax yourself so that you can mitigate the risk of being stressed and frustrated. Regular breaks also very essential for maintaining mental clarity. If you are not taking regular breaks, then what will happen? You will gonna eventually frustrate out, and you will have too high anxiety, and it will gonna impact the overall trading performance. So that you need to take regular break, and it will gonna relax your eyes, it will gonna relax your body, and it will avoid taking impaired decisions. How you can incorporate regular breaks into your trading routine is you can set a timer that you will not gonna watch the screen continuously for more than 20 minutes or 30 minutes before you take a break. Okay, and you can set a timer for your breaks also, that after every 1 hour you will stretch your body or you will drink water. These kind of breaks can help you stay fresh. You can follow the 20-20-20 rule. The technique will be, after every 20 minutes, look at something 20 feet away for at least 20 seconds. This will gonna help you reduce the eye strain and mental fatigue. You can look out of a window, or you can look out for a tree outside your office. It will gonna give your eyes a good break. You can engage in physical activity. You can use your break time to take a stretch, or you can go for a very short walk or do some light exercise. Trading psychology is just not the mental exercises. You need to keep your body healthy also. So you should take healthy foods, stay hydrated, and you can keep a bottle of water at your desk and have some fruits for a quick energy boost. This will gonna enhance your decision making, plus it will gonna avoid any kind of impulsive moves. The last factor is journaling is the most important thing that you have to practice it, because journaling involves keeping a detailed records of your trades, including your thoughts, your emotions, and reason for entering or exiting a trade. It helps you track your performance and identify patterns in your behavior. Your journal is your friend. It will gonna show you your strength and also your weakness, and on that particular weakness, after some observation, you can do the planning activities, that how you are going to improve that particular weakness. You can use a physical notebook to take your notes, to record your trades, or you can also use some digital tools like Excel, or you can use any kind of automated trading journal which is available on the internet, and you can use some sticky notes on your desk to remember some silly and very important points that you have observed from your mistakes. Or you can also use your phone notes to quickly write down what you have observed in the market. That will gonna enhance your strategy, your analysis, and your executions. Let me show you how I manage my journaling process. So what I have done is, I have created a Excel file which involves each and every minor detail that I am doing in the market. So you can see this trade sheet on your screen. It involves date part. You have the date, then the currency pair you are trading, you can write down, and whether you are going long or whether you are shorting a trade. Then you can enter the entry price, you can enter the stop loss price, so that you always know that how much you have risked on the particular trade, and you can write down the exit price, at what level you have exited. Then you can mention the target level your trades have achieved. Okay, so some targets will be first, some trades will gonna give you second targets or third targets also, and some will gonna hit you stop losses. So recording each of these elements will gonna boost your confidence, and it will gonna show you that you are doing good in this market condition and you are not doing good in range bound market condition. So you can make a plan to improve your range bound trading strategies. All right, and whether you have won or lost in a particular trade and how much money you have made on a single trade, what will be the state of mind that you were when you have executed that trade. It was it a impulsive trade you took, or was it a good trade based on your analysis, whether there is an execution error or not. Okay, and you can also add the links of your chart. You can take reference from the actual chart in the near future. That will gonna show you, okay, the structure is similar or not. All right, so this is how I manage my trades, and I have also created a trade summary which will gonna give me the overall view of the previous trade that I have entered here in very concise way. So here you can see the total number of trades I have took, the number of trades I have won, and the losing trades, average winning trade, average losing trade, and the PNL, and the trade cost that you are paying, and what is the maximum winning streak. So my winning streak would amount to 14, means I have won 14 trades in a series without any single stop loss, and I have also 4 losing streak, means consecutively I have lost 4 trades continuously. This is my highest losing streak. So what is the benefit of all this thing? So you know, after this recording or in journal, you know that okay, it's okay for me to have even 4 losing trade. I can pick up the pace after that 4 losing trades also. Okay, because we are trading in probabilities, not in certainties. Here is the detailed summary by on month basis. You can create that also. That will gonna show you that in that particular month what will be your performance is, and you should add up some notes section also, that you can record your observed point in the same trading journal. So you do not have to move from one diary to another to record all of the things. Okay, this is digitally access it anywhere. So you can write down the improvements that are required in your trading. If you have any new ideas, you can write it down, because what happens if you have any new idea out of blue and if you do not write it down, then what will happen? It will gonna bounce, and you do not remember it when it's time for it to execute. So that is why write down your ideas, and whether you are doing good in the psychological aspect or whether you are doing anything wrong on the psychological aspect, write it down. So it will gonna help you a lot. So that's all for this video. Make sure to subscribe to our community channels to stay updated. Thanks for sticking around. If you found this video helpful, there is plenty more to come in our series on Forex and technical analysis. And do not forget, for all your trading needs, visit tribe.com. For more in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I'll see you in the next video.